The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very good morning and a warm welcome to Squawk Box Europe. I'm Juliana Tatelbaum with Carolyn Roth, and these are your headlines. A December to remember. The Federal Reserve faces its deepest split in years as the central bank kicks off its two-day policy meeting, with hawkish commentary putting investors on edge.
President Trump greenlights exports of Nvidia's H200 AI chips to China, with 25% of sales to be paid to the U.S. government as part of the deal. Paramount has no chill, crashing the Neflix party and launching a last-minute $100 billion offer for Warner Brothers Discovery. As the bidding war heats up, Paramount CEO David Ellison tells CNBC a deal with Netflix should not be allowed.
It's bad for the consumer. It's bad for the creative community. This deal, if it is allowed to move forward, will actually be the death of the theatrical movie business in Hollywood. We're sitting here today trying to save it.
Fed officials begin their two-day policy meeting today, with their rate decision and updated projections due for release tomorrow. Markets are pricing in a nearly 90% chance of a rate cut, according to CME's Fed Watch tool, but that masks division among policymakers. Susan Collins and Jeffrey Schmidt have signaled their preference for a hold, and a number of officials have warned of the need for caution, potentially setting the stage for a hawkish cut tomorrow. We'll get updated forecasts from officials in the all-important dot plot in September. The median dot showed only one rate cut in 2026, and traders will be closely watching for any changes there. But there are all questions over how important those projections will be, as President Trump, of course, continues his quest to reshape the Fed. His bid to remove Governor Lisa Cook over allegations of mortgage fraud will be heard by the Supreme Court in January, potentially creating a vacancy for Trump to fill. Meanwhile, prediction markets and media reporting suggests loyalist Kevin Hassett is next in line to become Fed chair. We heard from the National Economic Council director yesterday as he pressed the case for further policy easing in the meetings ahead.
I think that Chairman Powell agrees with me on this one, that we should probably continue to get the rate down some, do so prudently with an eye on the data. And so I think that it's an example of, you're managing a committee. The committee was really in diverse opinions before, and it looks like Chairman Powell has done a good job of getting people to circle around to futures markets the right answer.
BlackRock's CIO of fixed income has also reportedly been interviewed in the search for the next Fed chair. Rick Reeder spoke to CNBC about his expectations for tomorrow's decision.
I don't think it's definitive, but I mean, you're going to have a cut, and I think the markets almost universally think it'll be a hawkish cut, and that he will have to give some time to have a number of members on the committee that are hawkish, and so I think he's going to cut. I think it's going to be a hawkish cut, but it's definitely not definitive that they go. If they weren't going, they'd probably transmit something in advance. So I think you got to put down that they're going to cut 25.
The Fed's meeting kicks off a series of pre-Christmas rate decisions from central banks around the globe. The S&P makes its decision on Thursday before meetings from the ECB, Bank of England, Norges Bank, Riksbank, and the Bank of Japan next week. Megan McDonald joins us now, CEO of Dawa Capital Markets Europe. Megan, it's great to have you with us. I think last time we spoke, you were fresh back from a trip to Japan right after Takaichi was elected. So amazing timing. And I want to get to what's going on in Japan in just a moment, but let's start with the Fed. The markets seem to be coalescing around the possibility of a hawkish cut tomorrow from the Federal Reserve. What are you thinking?
We see the same. We're very much aligned with and obviously from a Japanese perspective, that's positive, because if we're expecting a rate hike from the Bank of Japan towards the end of next week and a cut from the Fed, it sort of brings those rates from the Fed and Japan closer towards parity.
What do you think the lingering appointment of a new Fed chair does to Jerome Powell's ability or authority to influence policymaking at this stage? It's clearly the looming question for next year. Who's going to replace him at this point?
Yeah, it's an interesting question. Obviously, we focus a lot on the Japanese markets and what that means. But I think even what you're seeing in Japan, which could be a proxy for what would happen in the US, you're seeing the government and the Bank of Japan being in lockstep, really, on fiscal policy, inflation. I mean, you're seeing in Japan, you might say, well, fiscal stimulus is the foot on the accelerator, and a rate hike is a foot on the brake. So you kind of, but what you are seeing is government and the central bank working together. And I think you're going to see more of that in the Fed as well, where we're used to this huge focus on independence of central banks. I think that's changing. And I think you're going to see that play out in the Fed as well.
Megan, this is Carolyn jumping in. Great to speak to you this morning. Obviously, all eyes on the BOJ and whether it's going to be hiking next week. Its normalization path has been a very careful one. Obviously, the BOJ does not want to rattle the markets. Do you think it is careful enough?
Absolutely. I think everything that Governor Ueda is doing is deliberate, it's purposeful, it's telegraphed. And so we're expecting a 25 basis points increase at the meeting either next week of the Bank of Japan or January. And then we don't expect another rate increase until the third quarter of 2026. So we're seeing this as a very orderly normalization. The Bank of Japan doesn't deal in shocks. And I think everything that the Bank of Japan does is very well telegraphed to the market. And this time it's the same.
Though recently, Megan, once again, we've seen the sell-off on the long end of the curve, the JGB sell-off. And again, we've got concerns about fiscal sustainability coming back to the forefront. Is that going to be a theme for Japanese JGB investors, bond investors, once again in 2026?
It's an interesting one to watch because we are seeing, obviously, the normalization of monetary policy in Japan, normalization of interest rates, which hasn't happened for 20 years. So what we are seeing is some changes and some gyrations in the bond market. So we're seeing yields go up. We're obviously seeing domestic investors favoring the shorter end of the curve. But interestingly, with yields going up, we're seeing more overseas investors going into the super long end of the curve. So these yields that are rising in Japan are prompting a rebalancing of the portfolio, where we are seeing, as I said, international investors coming more into the longer end of the curve. There are obviously concerns around debt sustainability, debt to GDP ratios. We don't see the debt to GDP ratio increasing too much from where it is currently, because you must remember the vast majority of the debt stock was issued at lower rates in a much lower yield environment. Obviously, it's being replaced by higher yielding debt, but we're also seeing nominal GDP growth. So the fundamentals in Japan are leading towards moderate GDP growth. We're seeing a 1% growth in 2026. So actually what we're seeing is when you look at a debt to GDP number, which for Japan is obviously very high compared to other economies, we're seeing that denominator growing, and we're seeing more of a steady state in terms of the growth of the numerator being obviously the interest bill.
Right, Megan, let's also switch over to equities. The Nikkei and Japanese equities at large obviously have had a really good run, not just in 2025, but also in 2024 when the Nikkei bulls were awakening once again. Does that story have further to run with Sonenomics? And is the main argument still the weaker yen?
We absolutely think that story has got more to run. I mean, we've seen obviously about a 16% growth in the Nikkei this year, which has outpaced the S&P 500 and the Nasdaq, similar for the topics. We see that based on fundamentals. We don't see that as a bubble. And some of the reasons for that is there is growth in Japan for the first time in 30 years. Japanese equities had flatlined in the previous 20, 25 years. We're seeing strong corporate profit growth. We're seeing investment in CapEx, in robotics, in automation, and that bodes well for future growth, production capacity. So we don't think it's being driven mainly by a weaker yen. We actually think the fundamentals of how the Japanese economy is transforming from a structural perspective. And of course, you've got governance reforms in Japan as well. There's a much more increased focus on ROE, on capital efficiency, which we haven't seen for a long time. So our prediction for the Nikkei next year is 55,000 in 2026, and we're predicting 3,750 for the TOPIX. And that's about 9 and 10% growth respectively. So not, far, pretty modest, I would say, compared to the 16% growth that we've seen in the Nikkei this year, but very much supported by fundamentals.
I remember really compelling structural drivers there. Let's wrap up with what you're seeing in terms of investor interest. You mentioned that you're seeing a lot of international interest, renewed interest in Japan and Japanese assets for the first time in a while. What about domestic investors? Now that we are seeing bond yields move higher in Japan, we know that the Japanese are major investors in treasuries, for example, major holders of treasuries. Are you seeing any signs of repatriation of some of that funding back into Japanese bond markets?
We're seeing the beginnings of it. I would say, again, probably like with everything in the Japanese bond market, it's slow and steady. So we are seeing some of that money coming back out of US treasuries into Japanese government bonds. We expect to see more of that, obviously, as rates increase. But again, we don't expect to see sort of the tantrum of the yen carry trade unwinding that we perhaps saw in the summer last year. It's going to be slow and steady. What we are seeing in equity markets, so there's about 10 trillion yen of domestic household savings in Japan. That's starting to need to move into higher yielding assets. And what we are seeing is about 20% of that household savings pool moving into equities. That's the highest it's been. And we're seeing the portion of cash at around 50%. So again, part of that structural transformation, both in the bond market and the equities market, being driven a lot by changes in domestic investor behavior.
Megan, thank you so much. Appreciate it. Megan McDonald, the CEO of Daiwa Capital Markets Europe. And we still have a lot coming up on this show. Nvidia, for example, winning approval to sell a key AI chip in China. Plus, Paramount going hostile as the bidding war for Warner Brothers continues. And we'll discuss all things tech with none other than Dan Ives, Global Head of Tech Research at Wedbush Securities. That interview is coming up at 9:30 London time. We'll be back in 2.
I'm Steve Sedgwick from CNBC, and in my new podcast, Executive Decisions, I ask powerful leaders about their decisions that changed everything.
I'm not frightened of making tough decisions, and I think leadership can be very lonely.
Business leaders should not stay quiet in a world which is super complex.
It is absolutely fine to also change your mind.
Tough calls, personal crossroads. These are the stories that we can all learn from. It's Executive Decisions from CNBC. Get it wherever you get your podcasts.
Welcome back to the program. Let's get you a market check as we gear up for the European market open in about 45 minutes time. Here's how U.S. markets closed up yesterday. It was a fairly downbeat but overall muted session in the U.S. All three of the majors ending lower. S&P 500 dropping about 35 basis points. The Dow Jones losing about 0.5%, and the NASDAQ pulling back by about 14 basis points. 10 out of 11 sectors in the market were negative over the course of the session. Communication services was the underperformer, down about 1.8%, while tech outperformed, gaining about 0.9%. But by and large, investors waiting for the big events this week, the main one being, of course, the Fed decision tomorrow. And now in terms of Asian trade, here's your look at the overnight session. You got a pullback in Hong Kong, that market down about 1.3%. The Shanghai Composite in mainland China also on the back foot alongside the Kospi over in Korea. But the Nikkei 225 bucking the trend up by about 14 basis points. In terms of European trade, yesterday we saw the Stoxx 600 fall by 7 basis points, second negative session in a row. The German market outperforming, similar to the trend we saw last week. And now this morning we are looking at a fairly muted start overall. The CAC looking to dip very slightly at the open and marginal gains elsewhere.
All right, let's stay in the UK. UK retail sales grew at their slowest pace in 6 months in the month of November. That's according to data from the British Retail Consortium. The group said pre-budget concerns hit demand, with analysts at KPMG saying Black Friday promotions failed to deliver the boost retailers were hoping for. Meantime, the Bank of England has invited employees to volunteer for potential layoffs as strained finances force the central bank to reduce headcount. That's according to Bloomberg, citing sources who say Ben Bernanke's modernization plans are pushing the BOE to reduce its operating costs by 8% next year. The BOE approved a 3-year budget plan in July and warned at the same time that it needs to meet an ambitious efficiency target in the next financial year in order to limit growth of industry levies. And the UK employment outlook has improved for the first quarter of 2026. That's good. The first increase in almost a year, according to data from Manpower Group. Michael Stull is managing director at Manpower Group and joins us now to discuss the findings. Michael, is it really just relieved that the budget is out of the way, or was there anything positive in the budget in terms of growth and pro-business? Because I didn't necessarily see that.
Yeah, I think a couple of things are happening in the labor market. And remember, although the numbers are up, they're still down pretty significantly year over year, where it's down 16 basis points. But what employers need, what hiring managers need, is surety in the marketplace. And so what the budget did, and getting the budget behind us, brought some of that surety into the market, and so that has helped with hiring intentions. I think the other thing that we see that's positive out in the marketplace is we are seeing this desire of companies to start investing back into their businesses. And so when we look at employers right now, we know that over half of them are looking to increase their investment in automation, in AI. All of those things are going to certainly increase jobs in the short term. So there's where we see the positives coming into the market. Less about the particulars within the budget, more about the fact that we have more surety into the marketplace.
Understood. Just want to pick you up on the AI point in terms of more confidence and investing in that automation as well. When it comes to AI, though, is it broad-based upskilling of the labor force of the employees, or is it really investing into AI solutions that would then take the employees' jobs?
Yeah, I think we're seeing two things happening in the marketplace, and in some sectors where you see as such things within software developers, you're seeing a much softer market than we have had for a very long time, because AI, the tools that are coming in, the investment that companies are making in software development, as an example, are reducing the costs. And so you have investment there that's reducing hiring. But on the other side, what we're seeing is that movement of technology, as an example, is moving more and more into the business as opposed to being in a separate function. And because of that, people out in the business need to have a better understanding of technology, how to apply technology, how to work with data, how to work with AI. And so that broad-based upskilling, that notion of lateral skills, is becoming much, much more important. And so we have to do both and invest in the overall skills of workers, and we have to invest in the tools that are going to unlock productivity.
Michael, you say that the uncertainty in the lead up to the budget caused paralysis among a number of employers here in the UK, and now they've got the confidence to begin making some longer term decisions again. When it comes to the sectors poised to see the strongest uptick in hiring, what are those sectors at this point?
Yeah, and we do see that where there is still strength, which is the fundamental strength within the UK, is in IT. We see that in technology broadly across all sectors, and then within professional services. So we see those areas as the ones that should continue and will come out first. And for us, as we have gone through these cycles over the year, the first thing that we look for is that investment in technology, because that usually leads the way. Where we're going to see some continued weaknesses is in such areas as hospitality, and you brought up retail earlier in the program. Those are the areas that are going to be continued to be pressured, especially when we see the wages, the minimum living wage going up at such rates. That increases the cost for employers. That reduces the opportunity for employment for people.
It's interesting to see that professional services is one of the key sectors where you do expect to see an uptick in hiring based on these survey results, because professional services is also poised to be one of the most disrupted when it comes to AI, when you think about accounting, consultancy, things like that. So is this sort of a short-term trend that we're likely to see more hiring from these firms, but eventually these are the very jobs that are going to be most at risk?
Yeah, and I think that's the thing that, quite frankly, we don't know. What we do know is in the short term, we're going to be making investments in it because those are the areas where AI has the most impact. These knowledge worker areas are the biggest areas for productivity gains. And so that's why we're seeing the investment there. That's why we're seeing the hiring in the short term. Now, in the long term, it'll be interesting to see how things play out. I think with other technology changes, what we have seen is organizations, the market adapt to it, find new jobs, find new ways of leveraging the technology to create value, and we see an uptick in employment. And so is there fear out in the marketplace that these jobs will go away? Yes. Do we know that's going to happen? I don't think so.
Michael, billion-dollar, or rather billion-pound question here. How do we solve the productivity growth problem in the UK? Any ideas?
I wish I had a great answer for you. For me, I think what's most important that we focus on within the UK is to have a very strong and clear industrial strategy. We get our investments behind that, and we develop the skills to support it. Because in the end, it's a very competitive global marketplace out there. The workers, the skills you have within your workforce are going to be the ways to unlock that productivity. And so bringing all of those things together give us the best chance to compete out in the marketplace.
Michael, appreciate the time this morning. Really fascinating conversation. Michael Stoll, Managing Director, Manpower Group. Now, on this week's episode of Executive Decisions, our colleague Steve, who you know very well, speaks to the CEO of London Marathon Events, Hugh Brasher, an entrepreneur whose beginnings started with growing and then selling the family business to the UK's largest sporting retailer, and the tough choices he had to make along the way. Before that, though, how Hugh's sport career followed in his family's footsteps.
My mother was French Tennis Open champion, both singles, doubles and mixed doubles. And my father was Olympic gold medalist in the steeplechase in Melbourne in 1956. And I think sport has been an intrinsic part of my life. Having said that, though, I always say that if I was a horse as a yearling, I'd probably have been sold for a huge amount of money because the stud value of my parents was probably quite high. But quite soon I'd have been a banger and in the selling hurdle, and I'd be glue now. So yes, it runs through my blood, but not quite at the standard of my parents.
But I hear you. I come from a family of sportsmen as well. My father played first-class cricket. My uncle played first-class cricket and football. And I am I love sport. I love it, but I'm pretty average at it, to say the least. Is that dispiriting for you, or was it a challenge as you were growing up? Your mother's a multiple French Open champion. Your father's was with Hillary on Everest, was with Bannister at the breaking of the 4-minute mile as well. Did it weigh on you at all?
No. Partly for lots of different reasons. Firstly, your parents are just your parents.
Yeah.
Right? You have no idea. I had no idea. People would be coming up to my dad and asking for his autograph, or coming up and having this deep conversation. I go to my dad, who was it? No idea. Just being polite. So I think you're just in an environment where they are normal people and you don't realize their achievements at the time.
You can listen to the whole episode with Hugh Brasher right now in the usual podcast places, and you can watch on our YouTube channel as well as CNBC.com. The episode will also air this weekend right here on CNBC.